Okay, so you want to own a budget airline. The pitch sounds simple. Buy some planes. Sell seats for less than the legacy carriers. Fill every row. Watch the money come in. Here's the seat you just booked. $39. Newark to Orlando. You feel like you won something. You didn't win anything. You walked into a menu, and you only read the first line. That $39 fare was never designed to make the airline money. In a lot of cases, it was designed to lose money on purpose, just to get your card number into the system. Frontier Airlines generated 62% of its 2024 revenue from something other than the price of the seat. Not fuel surcharges. Not the flight itself. Extras. Spirit was close behind at 58.7%. Volaris at 55.3%. Breeze at 54%. Allegiant at 52.9%. 5 airlines. All of them now make more money from what you add to the cart than from the seat you started with. This is not a story about cheap flights. This is a story about a machine built to sell you 40 things after it sells you one seat, and about what happens when even that isn't enough to keep the lights on. Add a carry-on bag to that $39 fare. Add a seat assignment so you're not split from whoever you're traveling with. Add priority boarding so your carry-on actually fits by the time you reach the gate. By the time you're done, that $39 flight can easily land closer to $150. The seat was never the number. The number was the hook. Let's be clear about what a budget airline actually is, because it is not a discount version of Delta. It's a completely different machine wearing the same shape. A full-service network carrier, Delta, American, Lufthansa, builds one price that bundles almost everything. A seat, a bag, sometimes a meal. The ticket is the product. A budget carrier, an ultra-low-cost carrier, does the opposite. The ticket is not the product. The ticket is the entry fee. The product is everything that comes after. Every single thing you assumed was included gets pulled out, priced separately, and put back on a menu. Your carry-on, your seat assignment, boarding before the mob at the gate. Even the seat back in front of you not fully reclining into your knees, on Spirit, is a feature they can charge to move you out of. And the numbers show exactly how far this has gone. For legacy network carriers, ancillary revenue, everything outside the base fare, makes up somewhere between 12 and 18% of total revenue. For ultra-low-cost carriers, that number runs 52 to 62%. In other words, at a network airline, extras are a side business. At a budget airline, extras are the business, and the flight is the delivery mechanism. Globally, this extras economy hit $148.4 billion in 2024 alone, across the industry, according to IdeaWorks Company and CarTrawler, the two firms that track this every year. One side of the industry is still selling seats. The other side stopped selling seats years ago and started selling optionality and pricing every single option separately. And here's the paradox that makes this whole model work. The airline needs the base fare to look almost embarrassingly cheap, because that's the number that shows up in the search engine. The lower that number, the more people click. The more people click, the more people there are to sell the other 39 things to. The seat isn't the product. The seat is the bait. And ancillary revenue is a bigger bucket than most people assume. It's not just baggage and seat fees. It includes commissions on hotel bookings and rental cars sold through the airline's app. It includes revenue from selling frequent flyer miles to banks for co-branded credit cards. For Delta, American, and United, that single category is worth billions of dollars a year, larger than most people would guess for something that sounds like a loyalty perk. It includes cargo space sold in the belly of the plane and services one airline sells to another, like ground handling. But at the ultra-low-cost carriers, the mix looks different. It's overwhelmingly a la carte: baggage, seats, boarding order, change fees, and, the fastest-growing piece, bundled fare tiers that repackage several of those fees into one slightly less annoying purchase. Look at who else made the top of the industry rankings in 2024, beyond the 5 airlines already mentioned. Wizz Air, Viva Aerobus, Velodia, EasyJet, Pegasus. Together with the leaders, they round out a top 10 where ancillary revenue runs from just under 45% of total revenue down to around 34%. As one industry analyst put it, cracking that top 10 takes maximum effort, focused on exactly 2 categories: baggage and assigned seats. Everything else is smaller money by comparison. Notice what's missing from that top 10: not a single full-service global network carrier. This isn't an industry-wide trend that happened to everyone equally. It's a specific business model executed by a specific type of airline, and it is now the dominant source of profit for that entire category of carrier. None of this existed as an industry standard 2 decades ago. U.S. Airlines started charging separately for checked bags on May 5, 2008, when American Airlines introduced a $25 first bag fee on domestic tickets. Within months, nearly every other major U.S. carrier had matched it. That single policy, copied industry-wide inside 1 year, is the moment the modern unbundling era actually begins. Everything since then, seat fees, boarding order fees, Wi-Fi, onboard snack menus, is the same idea, applied to one more line item at a time. So if the seat is bait, what's actually expensive about running this business? Because someone still has to pay for the plane. Start with the aircraft itself. A new narrow-body, an Airbus A320neo, a Boeing 737 MAX, runs well over $100 million at list price, though almost nobody actually pays list. Most budget carriers don't even buy outright. They lease. That's the first hidden layer most people never think about. The airline in front of you, the one with the bright paint job and the cheeky boarding announcements, frequently doesn't own most of its planes. It leases them from companies like AerCap, and those lease payments are due every single month, whether the plane is full or sitting empty on the tarmac. Then comes fuel, historically the single biggest line item on any airline's cost sheet, and the one number that no airline, budget or otherwise, controls. Jet fuel prices move with global oil markets, and a budget carrier running paper-thin margins has almost no cushion when fuel spikes. Then the maintenance layer, and this is where it gets specific. Newer, more fuel-efficient engines, the Pratt & Whitney geared turbofan family, used on the A320neo, have had a well-documented reliability problem requiring early inspections. Airlines running heavily on that engine type have had to ground aircraft they already paid to lease, taking the plane out of revenue service while still paying for it sitting still. Now stack the fee layers most passengers actually see. Layer 1, baggage. U.S. airlines collectively pulled in roughly $7.3 billion in baggage fees in 2024 alone. In just the third quarter of 2025, checked bag revenue hit $2 billion across the industry's scheduled carriers, 3.1% of all operating revenue, industry-wide, from bags alone. Layer 2, seats. This one crept up quietly and then overtook the first layer entirely. At United, seat selection revenue, roughly $1.3 billion in 2023, actually passed checked bag revenue that year. The first time a major U.S. network carrier made more from where you sit than from what you carry. Layer 3, priority boarding, change fees, in-flight food and drink, Wi-Fi, seatback advertising, even the credit card you're pushed to apply for mid-flight. One side of this, the carrier's biggest fixed costs, the plane, the fuel, the engines, the lease, barely move no matter how many extras you buy. The other side, every extra you buy is close to pure margin, layered on top of a base fare that was priced to just barely cover, or not even cover, its share of those fixed costs. That gap between the two, between what the plane truly costs to fly and what the base fare charges, is exactly the gap the entire ancillary machine exists to fill. But before any of that fee stacking even starts, there's an entry cost most passengers never think about at all, the certificate that lets an airline legally operate in the first place. In the U.S., getting an air carrier certificate from the FAA is a process that regulators themselves describe as typically taking well over a year, sometimes closer to 2, involving 5 separate phases of pre-application, formal application, document compliance, demonstration and inspection, and certification, before a single paying passenger ever boards. In Europe, the equivalent air operator certificate process runs on a similarly demanding timeline through ESA and national regulators. Then there's the question of where you're even allowed to land. At capacity-constrained airports, the London Heathrows, the New York LaGuardias of the world, takeoff and landing slots are a fixed, scarce resource. New entrants either buy slots from an airline willing to sell, lease them, or get shut out of the routes that actually carry premium demand entirely. This is one reason nearly every successful budget carrier of the last 2 decades built its network around secondary airports, Ryanair flying into regional fields well outside city centers, Allegiant connecting small U.S. cities to leisure destinations most network carriers ignore because the primary hubs were never realistically available to a new low-cost entrant in the first place. Add insurance, which for an aircraft fleet is its own specialized, expensive category, and add the simple fact that pilots and mechanics require years of training and type-specific certification that isn't interchangeable between aircraft families. None of this shows up in the $39 fare. All of it sits underneath it. Here's the other side comparison that explains why budget carriers put up with all of this in the first place. A network carrier's cost per available seat mile, the industry's standard yardstick for how expensive it is to fly one seat 1 mile, runs meaningfully higher than an ultra-low-cost carrier's because of denser seating, faster gate turnarounds, single aircraft types that simplify maintenance and training, and older debt-freer fleets in some cases. One side of the industry accepts a higher cost structure and prices a bundled ticket to cover it. The other side fights for the lowest possible cost per seat mile in the industry, prices the seat itself barely above that number, and plans to make the actual profit somewhere else entirely, in the fee stack sitting on top. So here's the machine, in motion. And to see it working at its most refined, look at Ryanair, the airline that arguably built the modern playbook. In its 2025 fiscal year, Ryanair pulled in €4.72 billion in ancillary revenue, up 10% year over year, representing roughly 30 to 32% of total company income. In the single quarter from April through June 2025, ancillary sales alone brought in €1.39 billion, a third of everything the airline made in 3 months. And Ryanair doesn't leave that number to chance. The airline runs dynamic pricing across roughly 20 different parameters on things like hand baggage fees, adjusting price in real time based on route, demand, and how close you are to departure. That single tactic alone shifted hand baggage share of total ancillary income from 24% up to 34%. Now look at who's winning the per-passenger race. Norse Atlantic, the Norwegian long-haul low-cost carrier, generates roughly $100 in ancillary revenue per passenger, the highest rate tracked in the entire IdeaWorks company yearbook. Spirit, even mid-crisis, has been running somewhere around $65 to $70 per passenger through 2025. Using dynamic pricing and tiered bundles, it calls go big, go comfy, go savvy. And as we're about to see, the story doesn't stop with independent budget carriers. Even the airline that spent 54 years refusing to play this game eventually joined it. In March 2025, Southwest Airlines, under pressure from activist investor Elliott Management, which had taken a stake and won 5 board seats, announced the end of bags fly free, its defining policy since 1971. By May 28, 2025, Southwest was charging $35 for a first checked bag and $45 for a second. Southwest itself estimated the move would generate $1.5 billion a year in new revenue. It also estimated it could lose up to $1.8 billion in business from loyal customers who flew Southwest specifically because bags were free. That single sentence, from Southwest's own numbers, is the entire ancillary economy in miniature. Pull a fee out of the base price, and you gain revenue from everyone who stays, while gambling on how many walk away. Meanwhile, upstream of the airline entirely, the money keeps moving to people who never touch a single passenger. The aircraft lessor gets the monthly payment regardless of load factor. The engine manufacturer gets paid for parts and inspections whether the plane flies or sits grounded. The credit card processor takes its cut of every ancillary transaction, the seat fee, the bag fee, the onboard latte. The airline is the only party in this entire chain whose revenue is uncertain. Everyone leasing to it, financing it, or supplying it gets paid on a schedule. The airline gets paid on hope. Hope that enough people click add to cart before the plane pushes back from the gate. It's worth pausing on why seat selection revenue, specifically, grew so fast across the entire industry, not just at the ultra-low-cost carriers. A seat isn't one product. It's dozens of slightly different products, sitting a few rows apart, and revenue management software can price each one individually based on how close to departure you're booking, how full the flight already is, and how much extra legroom is worth to someone traveling for work versus someone traveling on a budget. That's the same dynamic pricing logic Ryanair applies to hand baggage, applied instead to the physical seat map itself, which is exactly how United's seat fee revenue quietly overtook its baggage fee revenue, without most passengers ever noticing the shift happen. And Volaris, the Mexican ultra-low-cost carrier, shows the same playbook translates across borders. By 2024, Volaris had crossed the 50% mark too, and its own dynamic pricing push on add-ons grew ancillary earnings by roughly 8% in a single push. This is not a U.S. phenomenon or a European one. It's a global operating system that any airline willing to unbundle aggressively enough can install. The growth trend backs this up year over year. U.S. baggage fee revenue alone climbed from roughly $7.0 billion across 18 carriers in 2023 to about $7.3 billion in 2024. It's grown steadily enough and become significant enough as a share of how Americans experience air travel that in November 2024, the U.S. Senate Permanent Subcommittee on Investigations published a majority staff report on the subject, bluntly titled, "The Sky's the Limit: The Rise of Junk Fees in American Travel." When a Senate subcommittee writes a formal report about your pricing strategy, it's a fairly reliable sign the strategy has become impossible to ignore. Not every airline moved in exactly the same direction, though. American Airlines eliminated change fees on most domestic and short-haul international tickets back in 2020, a policy Delta and United matched and have maintained since. Proof that unbundling isn't a one-way ratchet applied to literally everything, even at carriers that lean heavily on ancillary revenue elsewhere. Spirit and Frontier, by contrast, have generally kept their change fees in place, consistent with the fully unbundled model each was built around from day one. Now watch what happens when that hope runs out. Spirit Airlines is the case study, and the timeline reads less like a slow decline and more like a countdown. November 18, 2024. Spirit Airlines files for Chapter 11 bankruptcy protection. By that point, the airline had lost more than $2.5 billion since 2020. The filing came after a failed merger with JetBlue, blocked by a federal judge on antitrust grounds in January 2024, and after a second failed courtship, this time with Frontier. The first bankruptcy was fast, prepackaged. Spirit had already lined up more than 75% of its senior secured note holders before filing, converting roughly $795 million of debt into equity. Aircraft leases were left untouched, fully repaid, unimpaired. Spirit walked out of court on March 12, 2025, under 4 months after walking in. And for a moment, it looked like a clean reset. Then, in mid-August 2025, Spirit issued a going concern warning in its own quarterly filing, the legally required admission that a public company might not survive as an ongoing business. 2 weeks later, on August 29, 2025, Spirit filed for Chapter 11 again. Restructuring advisors have a nickname for this. They call it Chapter 22. The numbers behind that second filing are worse than the first. $2.4 billion in long-term debt, most of it due in 2030. Negative free cash flow of roughly $1 billion by the end of the second quarter of 2025. Between March and June of that year alone, Spirit lost nearly $257 million, despite having forecast a $252 million profit for that exact stretch just months earlier. And this is the detail that connects everything back to the cost stack. 38 of Spirit's aircraft were sitting grounded, waiting on inspections tied to that same Pratt and Whitney geared turbofan engine problem, out of a fleet where nearly all 79 of those engines needed some form of repair within 2 years. Grounded planes that Spirit was still paying to lease. 5 days before the second filing, on August 25, 2025, Aircraft Lessor AerCap sent termination notices covering 73 planes. Around the same time, Spirit's credit card processor, Elevon, began holding back cash against future refund risk, $50 million up front, plus roughly $3 million a day afterward. Cash the airline needed to keep flying, frozen by the one party in the chain that never has to worry about its own revenue. Spirit spent the next several months trying to restructure its way out, shrinking its network, cutting 11 cities including Albuquerque, Boise, Sacramento, and San Diego, furloughing roughly 270 pilots, downgrading 140 captains, and furloughing nearly a third of its flight attendants, about 1,800 people, by December 2025. It wasn't enough. On May 2nd, 2026, at roughly 3 in the morning, Spirit Airlines shut down entirely. 34 years of flying ended in a wind down, not a rescue. A fuel price spike and a collapsed federal rescue effort finished what 2 bankruptcies couldn't fix. Here's the part worth sitting with. In 2024, Spirit generated 58.7% of its revenue from ancillary fees, one of the top 5 most successful ancillary machines in the entire global airline industry. The Extras engine worked exactly as designed. It just wasn't the thing that was actually broken. And Spirit wasn't the only major airline restructuring in this same window. Brazil's GOL filed Chapter 11 in the same period as Spirit's first case, in 2024, and both airlines confirmed reorganization plans and exited within the first half of 2025. But GOL's story split off from there. GOL has continued operating since exiting bankruptcy. Spirit, 5 months after its own exit, was filing again. Same courtroom playbook, same restructuring advisor's toolkit, 2 completely different outcomes, which tells you the paperwork was never the deciding factor. Look at the fleet number underneath all of it. 213 Airbus A320, family aircraft on Spirit's books at the end of 2024. A fleet that was more than half newer generation Neo variants. The planes that were supposed to be the fuel-efficient future of the airline. Heavily encumbered by leases with built-in payment escalation clauses, and increasingly grounded by the very engines meant to make them cheaper to fly. So who actually wins in this business? Not the operator selling you the seat. The parties standing outside the plane, collecting regardless of what's happening inside it. The aircraft lessor gets paid whether the plane is full, half-empty, or grounded for engine repairs. The engine manufacturer gets paid for every inspection cycle, crisis or no crisis. The credit card network takes its cut of every ancillary dollar the airline works so hard to generate. The airport collects landing fees and terminal rent on a fixed schedule that has nothing to do with Tuesday's load factor. Compare the 2 paths sitting side by side in this same industry right now. Ryanair, no fleet financing crisis, ancillary revenue climbing every year, for €0.72 billion of it in fiscal 2025 alone, margins protected by scale and by 2 decades of fuel hedging discipline. Spirit, an equally aggressive ancillary machine, 58.7% of revenue from extras, and a fleet debt, lease, and engine reliability problem large enough to erase every dollar that machine generated. The difference was never the fee strategy. Both airlines mastered the exact same playbook, stripped the seat down to nothing, charge separately for everything else, price it dynamically, optimize relentlessly. Frontier runs the same playbook and sits at 62% ancillary revenue, the highest ratio tracked anywhere in the industry, and it is not the one that shut down. The difference was the balance sheet sitting underneath the playbook. Ancillary revenue can fund a well-capitalized airline into real, sustained profit. It cannot, on its own, outrun $2.4 billion of debt, a grounded fleet, and a lessor calling in 73 aircraft at once. The seat fee model doesn't fail. The airlines running it without a cushion do. Widen the lens one more step and the pattern holds across the entire aviation financing world, not just this one airline. Aircraft lessors like AerCap manage portfolios of thousands of planes across dozens of airlines specifically so that no single carrier's trouble sinks them. If one airline can't pay, the plane gets repossessed and released to someone else. Engine makers sell long-term maintenance contracts priced to be profitable across the whole fleet they service, not dependent on any one customer's survival. Airports collect from every airline using their gates, so one tenant's bankruptcy is a bad quarter, not an existential threat. The airline is the only node in this entire network that has no equivalent diversification. It only has the one business, the one fleet, the one bet on how many passengers click by this quarter. Even the aircraft manufacturers sit above this risk. Boeing and Airbus both carry order backlogs stretching years into the future, spread across hundreds of airline customers on every continent. If one ultra-low-cost carrier in one country stops flying, the backlog barely notices. The manufacturer simply moves the next airframe on the list to the next customer waiting in line. Demand for new, more fuel-efficient aircraft has, if anything, only grown as fuel and engine reliability pressure pushes more carriers to want newer planes faster. The exact pressure that helped push Spirit toward the edge is, for Boeing and Airbus, a tailwind. So line up the full chain, from top to bottom. The manufacturer, diversified across hundreds of customers, protected by backlog. The lessor, diversified across thousands of aircraft, protected by repossession rights. The engine maker, paid on inspection cycles regardless of who's flying. The airport, paid by every tenant, not just one. The credit card network, paid a percentage of every transaction, win or lose. And at the very bottom of that chain, absorbing all the risk that everyone above it structured their way out of, the airline, and specifically the ultra-low-cost airline, whose entire business model depends on convincing enough people, flight after flight, to keep clicking Add to Cart. So think back to that $39 fare, the one that felt like a win. It was never a mistake, and it was never generosity. It was a number engineered down to the floor, on purpose, to get you into a system built to sell you everything the seat itself doesn't include. A system so effective that airlines using it can generate over half their revenue from extras and still, in the worst cases, run out of runway. You paid $39 for the seat. The airline is betting on everything you buy after it. So here are the two questions worth sitting with, side by side. Is $39 actually the price you're paying, or just the price you're being shown? And if the company selling it to you is betting its entire survival on what happens after you click buy, how sure are you that it wins that bet before you land?